Hi, my name is Kobe, an associate with Noor Private Wealth. If you're new to my channel, we focus on helping individuals build wealth in the most tax efficient way. So if that's something that you have interest in, make sure to subscribe so you don't miss out on anything important. And in today's video, I'll do a quick recap of what happened during the month of September and give you a future market outlook. And as always, if you like this video and you find it helpful, make sure to hit the like button. It really helps with the YouTube algorithm. So let's jump right in. It has now been more than 6 months since the World Health Organization declared the global COVID-19 pandemic changing our home and working lives. As the initial wave of infections lowered and the virus spread stabilized through the summer months in most parts of Canada, we adapted to the new normal. Heading into the fall, infection rates in some provinces are rising again, raising the possibility of further restrictions to limit the virus's spread. Now, recovering from the pandemic-related downdraft of the first quarter, financial markets enjoyed a period of relative calm and optimism through the summer of 2020. Equity prices in many markets continue to improve, with some sectors moving sharply higher as lockdown restrictions eased and economic activity gradually resumed. Towards the end of the third quarter, however, investor concern resurfaced. Markets were rattled by growth in the numbers of COVID-19 infections, uncertainty related to the upcoming US presidential election, and the expected economic stress of reduction in government support for businesses and individuals. The correction in September is a healthy one for the markets, and it keeps us away from bubble forming. Ironically, volatility validates market efficiency. Much of the media focus until November 3rd will be the US election. There are two things that are essentially inevitable every 4 years: a US president elected, and not coincidentally, an increase in investors' questions about how the outcome will impact the financial markets. An election rarely has an impact in the short term. While government policies can have an impact on the economy and markets, it's rarely immediate or profound. There are even times that markets react to policies enacted by the outgoing president to the benefit or deterrent of the incoming one through no fault of their own. Markets are somewhat less enthusiastic in election years. The S&P 500 index has posted an average return of 9.95%, including dividends, during a year in which Americans elect a president. In years when a president is seeking re-election, which is the case we have now, markets returned on average 14.3% compared to 4.5% when a new president must be elected. The sharp rise in stocks since March might seem excessive to some people. Stock prices are back up to their old highs, even though earnings remain well below their past peaks. Just remember, a rising market climbs a wall of worry. This is one of those rare stock market slogans that makes sense and fits very nicely on a t-shirt. A modern economy has a lot of moving parts, and it's the job of the media to find and report the parts that are running into problems. That's why in a rising market, you can always look around and spot reasons why you should sell. These potential problems are the bricks that go into that wall. Most of them gets fixed long before they spur a market downturn. Our view now is that stocks are still a good place to put your money in if you can afford to stay invested for several years. That's it for today's video. I hope you found it valuable, and if you haven't done that already, make sure to hit the like button, and if you want to see more videos, don't forget to subscribe. If you have any questions or comments, please let me know below. I read and answer every single one. Thank you very much for watching, and I will see you next time.